All right, welcome to video 1 of this series. Today we're going to be covering health insurance, just some basics about health insurance. Health insurance, I personally found, was a little bit more confusing than life insurance because life insurance is very conceptual. So there's a lot of things in life insurance you can visualize. Health insurance, typically, for me anyway, required a lot of just like straight memorization of facts. So I found that people, when studying for their pre-license exams, find health insurance a little bit more tricky and a little bit more challenging than life insurance. That's not everybody. If you are less of a visual learner and more of like, hey, just give me all the information, let me memorize it for the test, then health insurance might be, you might like the health insurance stuff more. But for me, health insurance was always just more, hey, all these different details, because there's a lot of different laws and rules and regulations and different organizations and things to it. So we're going to dive in just to the basics here. And hopefully by the end of this series of videos, you'll have a better understanding of health insurance, what it is, and just overall understand it to help pass your test better. So we're going to cover the big picture here. So we're going to break down the fundamentals of health insurance protection. And first, we'll cover what health insurance covers. So health insurance covers, by the way, in your state, they might refer to it as health insurance or health in sickness, or health accident in sickness, or accident, health, or sickness. Every state might refer to it something different. We're going to cover everything here. Injury. So health insurance covers bodily harm resulting from accidents, like car accidents. So you're driving around, you get hit. Maybe you're working and you're on a construction site and a hammer falls and hits you in the head. Maybe you play sports and you break your leg or something playing a soccer game. Or you just fall. Humpty Dumpty. I don't know if Humpty Dumpty had health insurance. Humpty Dumpty had a great fall. I don't know if he had health insurance. I don't know if eggs can actually get health insurance. But fortunately, we can, and we don't just split open every time we fall. Hopefully not, anyway. So falls, other accidents. And it covers illnesses. So sicknesses or diseases like infections, viruses, which if you hear in my voice, I am just getting through a virus. And fortunately, I have health insurance. So it's more typically medical expense insurance. So I was able to be sick and actually stay home and do a teledoc and reach out and be like, hey, dude, I can't breathe. So he wrote me some prescriptions and I went and got them from the pharmacy. Also chronic conditions, diabetes, stuff like that, diseases, and mental health conditions. So with health insurance, it goes under the principle of indemnity, which is to return you to the same financial state that existed before the loss occurred. This is a big theme on your pre-license exams. So a valued contract, which is like life insurance, is something where it's for a specific value. So if you're not studying for life insurance right now, then it's okay. This is going to help you understand it. So life insurance, once you die or someone dies who's insured, a specific amount of money is paid to the beneficiary. Like they already know how much the benefit's going to be before that person dies, right? So if you have a $100,000 life insurance policy, it's a reimbursement not reimbursement. It's a valued contract, which means that we know no matter how this person dies, what the circumstances are, $100,000 is going to be paid out. Health insurance, though, is a reimbursement contract. So it operates under the principle of indemnity to return that person to the same financial state that existed before the loss occurred. So I'll give you an example with me being sick just now. I had to go get medications, right? And I could have gone to the pharmacy and just bought some stuff over the counter, but I called my health insurance company and did teledoc. And instead, he wrote me a prescription for the medications that I was going to go buy. Now there's some cost sharing involved, but basically, it was intended to cover those things for me. So I don't make money off of it, right? I don't make anything off it unless I go sell my cough syrup, which no one's recommending to do. But I don't make money off of it. It just brings me back to the state before, right? It brings me back to the previous state. Sorry, hummingbird outside my window. It brings me back to the state I was in before the loss. So say there's something catastrophic. Say you have surgery, like a big surgery. Well, that surgery, if you had to come out of pocket for it, is a lot of money. And basically, it's to reimburse you. Now, I know a lot of times we don't look at it this way because health insurance just writes the bill or pays the healthcare provider directly now a lot of times. But imagine if you had a loss, you went and paid for your surgery, $5,000, and then you filed the claim with the insurance company and say, hey, I just paid for the surgery, please reimburse me. That's the principle of indemnity. So hope that helps you understand where life insurance, being a valued contract, gives you a certain amount of money no matter what, a specific amount. Health insurance is designed to get you back to where you were before the loss occurred. Okay, so there are three main categories of health insurance. We have category 1, which is medical, surgical, and hospital expense. Category 2, which is disability income insurance. And category 3, which is accidental death and dismemberment insurance. We will get into these in further detail in subsequent chapters, but I'm going to go over a broad overview of it right now. So category 1, the medical, surgical, and hospital expense. This covers costs related to medical services, surgeries, hospital stays, doctor visits, and outpatient care. So outpatient care is when you go to the the hospital for something and you leave that same day. Medical services, when, I don't know, anything you get service for medicine, maybe labs, stuff like that. Surgeries, you get a surgery, you go to the hospital. Basically anything, if you get sick and you have to seek a healthcare professional, medical, surgical, and hospital expense insurance are designed to cover that. Category 2, disability income insurance. So this provides income replacement if you can't work. So if you get too sick, maybe you get a disease and it impacts your ability to move. Maybe you get injured and they can give you weekly or monthly payments. This does not cover medical expenses though. This is just loss of income insurance. It's also considered. So if you get disabled, you probably know what disability insurance is. The basics of it anyway. We'll get into detail later. And then accidental death and dismemberment. So this is if you die on an accident, as a result of an accident. Okay, so you lose your limbs, maybe you lose eyesight, you die on accident, or you have severe injury from accidents. Okay. And next we'll cover why health insurance is important. So a single hospital stay can cost over $50,000. I think at the state our country's in, everybody understands how expensive healthcare is. It's almost unaffordable. It's unaffordable without insurance, and it's almost unaffordable. Insurance is almost unaffordable sometimes. So without insurance, you have to pay 100% of this cost. If you lose your health insurance, or losing your health, like getting sick or getting injured, medical bills are huge. You lose wages, and medical debt is actually one of the leading causes of bankruptcy. So with insurance, you get financial protection. You share the cost with your insurance company. So we'll be going over some cost sharing. Income replacement, so disability benefits keep money coming in, and peace of mind focuses on recovery, not bills. So you don't have to get stressed and think you're going to be homeless because you got sick or injured. So that's it for our first video for this chapter on the basics of health insurance. And I hope you enjoy the next video coming up as well. Right, video 2, we're going to be covering medical expense insurance. So hopefully by the end of this video, you have a better understanding of what medical expense insurance is. So medical expense insurance is designed to help you cover your bills. Because as we said before, a single hospital stay can cost $50,000 or more. So here's how medical expense insurance can protect you and your clients. So medical expense insurance is also considered reimbursement insurance. So the way it works is you receive medical care, and then you or your provider submit the claim. So either you submit the claim or the healthcare provider. A lot of times the hospital will actually submit the claim because they want the money, right? They don't trust you to submit the claim to get the cash to pay them. They're like, no, we're cutting you out. The insurance company reviews the covered expenses, and then you get reimbursed for medical costs, or they just pay the healthcare provider directly. So unlike life insurance, like I said, which pays a set amount, medical expense insurance reimburses you for actual costs incurred up to policy limits. So what gets covered? We can have hospital services, surgical costs, so hospital service, so inpatient stays, if you have to stay overnight, get treatment and services at the hospital, you get an IV, you get food, you get all that stuff. Surgical costs, so surgeries, surgeon fees, surgical procedures, doctor visits and services under physician costs, medical treatment, so physical therapy and rehab, outpatient care, consultations, diagnostics, labs, stuff like that, and then prescriptions. So what medications are covered? Which medications are covered? Now we're going to go over cost sharing. This is a very important topic of health insurance or medical expense insurance. And it's going to help you understand, you're going to need to know this for your exam. So the first form is, well, obviously you have your premium. So this is above and beyond your premium. So you pay a monthly, quarterly, annually, semi-annual premium, which is most people pay it monthly. So it's like the monthly cost for your health insurance. When you go to file a claim or when you use the insurance, there are some other cost sharing methods involved. And these are designed to minimize the number of claims that people file. And it's designed to keep healthcare costs lower, even though they're not. So first one is copayments. So $30. So say this is an example. Not every copay is $30, but example, every time you go to the doctor, you have to pay $30. Everyone here probably knows what a copay is. If you have children, then you definitely know what a copay is, and unless you don't have copays, but every time you go in, you got to pay money. Then there's a deductible. So this is the amount you have to pay before insurance kicks in. So for instance, you pay the first $1,000 of medical costs each year. So let's say you go to the doctor and it's $30. And then you get, so you break your arm, you go to the doctor and you have to pay $30 to see the doctor. And then let's say all the fixing and everything costs $2,000. So you have to pay the first $1,000 before insurance kicks in. Now, there are many different types of deductibles, and we're going to be covering these in some of these videos. Most of the time, the deductible is just like you have one annual deductible. I'll get into the exact names of the different types in other videos, but basically you have one deductible typically, or a family deductible, but where for the year, you have to pay the first $1,000 out of pocket, and then after that, the insurance company will cover a percentage of it. So for instance, here, for the deductible, you pay the first $1,000 of medical costs each year, and then coinsurance kicks in. So 20%. So coinsurance covers a percentage of the costs. So example, in an 80-20 plan, you pay 20% of the costs after the deductible is met. The insurance company covers 80%. All right. The lower your copays are, typically the higher the premium. The lower the deductible, the higher your monthly premium. And the lower your percentage of the coinsurance, the higher the monthly premium. Okay, we'll get into that more. So we're going to give another example here. So you meet your deductible. First $1,000 of cost, you pay 100% of it. Coinsurance kicks in after you meet your deductible. So you pay 20%, for example. Some plans are 90-10, some plans are 80-20 like this one, some plans are 70-30. There's all different types. But in this one, for example, if it's an 80-20 coinsurance, and then you hit your out-of-pocket maximum. So example, after you've paid $6,000 total, the insurance company pays 100% of everything else. So for the rest of the year, you pay nothing for covered services. So basically, you have your copay, and then the deductible. After the deductible is hit, you pay a certain percentage of the services. And then after you hit your annual out-of-pocket maximum, the insurance company covers 100% of everything else. So out-of-pocket maximum does not include your monthly premiums or costs for non-covered services. Okay, sometimes you have to get approval before treatments. So hospital admissions, surgeries, MRIs, specialty drugs. In some different types of medical expense insurance plans, particularly HMOs, there's some other types, you need to get some sort of approval before you get the treatment. So with an HMO, which is a health maintenance organization, you have to have a primary care physician, and your primary care physician, it organizes the coverage, or organizes the treatment. So basically, you go to your primary care physician, you say, geez, man, my back really hurts. He says, okay, I'm going to send you to this specialist to get an MRI done. And then I'm going to refer you to this specialist for potential surgery. Versus with a PPO, which we'll learn about, preferred provider organization, you can just go, you don't need a prior authorization sometimes. But for insurance claims, that has to do with the insurance side with seeking healthcare professionals, but with insurance claims, also what this is saying is that like you can't just go have a procedure done and then just submit it and say, oh, I want this paid for, right? Because there's some procedures that are not authorized under your insurance. So let's just say you want some sort of cosmetic procedure, right? So you want to have you get a nose job, and it's not for you don't have breathing issues or anything. You just don't like the way your nose looks, and you want to change the way it looks. Health insurance typically won't cover cosmetic procedures. For instance, me, if you see some of my other videos, I had a mullet and I had receding hairline. I got a hair transplant here. Health insurance was not going to cover that. So I had to pay cash I didn't walk in with a briefcase of money, but you get the deal. Because health insurance does not consider that they don't authorize that, right? So for a lot of times, for a lot of services, you need to have prior authorization before you get the treatment, okay? And that's for the health insurance company to make sure that, hey, this is something that you actually like need to get done. Also, insurers limit reimbursement to typical costs in your geographic area a lot of times. So if your healthcare provider charges more than the usual, reasonable, and customary charge, you pay the difference. So let's say maybe there's a healthcare provider who thinks he's like the best arm break repair specialist in the world. And you're like, hey, I broke my arm, but my insurance will cover $5,000 of it. He says, great, well, I'm going to charge $7,000. You might have to cover the difference. Usually insurance figures it out though with these people. And then there's also maximum benefit limits. So on some policies, some policies set maximums on what they'll pay. So maybe they'll have a total lifetime maximum where in your entire lifetime, there's a max that they'll pay. Or maybe there's a maximum per year or a per cause maximum, which is for a single illness or injury. So they say, look, you broke your arm. Like, we get it. You need a cast and stuff, but like, there's only a maximum amount that we might pay for this arm break. Okay. But however, Affordable Care Act plans, so the Affordable Care Act of, I think it was 2010, could be wrong. That's important. You guys will want to know the date of the Affordable Care Act. I'm going to look it up real quick. Affordable Care Act date. I'm like 90% sure it was 2010. Yeah, March 23rd, 2010 by President Barack Obama. So this is the Affordable Care Act. ACA plans no longer have lifetime or annual limits for essential benefits. So that was one of the key features of Affordable Care Act, that there can't be a limit for essential benefits. We'll get into the essential features of the Affordable Care Act at another point in this course. So next video, we're going to move on to disability income insurance, the basics of it. There's a whole chapter dedicated to disability income insurance, but in the next video, we'll cover some basics of it. If you're serious about passing your insurance exam on the first try or the next try, if you've already failed, I've got you covered. Click the link in the description to check out our pre-license courses with a 93% pass rate. We hope over 30,000 people per month get licensed, so let's make you next. Okay, the third video in this chapter series, we're going to be covering some basics of disability income insurance. Now, we are going to cover disability income insurance in more depth in another chapter, but we're going to cover some basics right here so you can get a feel for it and what it's all about. So disability income insurance is about protecting your paycheck. So if you become disabled and you can't work for another 6 months, what happens? So this is the insurance that pays your bills when you can't. So they don't actually go and pay your bills, clear this up here, but they do send money every month to replace your income or week so that you can use it to pay your bills. So that was just like a saying, the insurance that pays your bills when you can't, even though people can use that money to pay their bills. Okay, what it's not. It is not medical expense coverage. Disability income insurance does not pay hospital bills, does not pay for surgeries, and it does not pay for doctors. What it does is it replaces your income, pays you directly, gives you weekly or monthly payments, and helps take care of you while you're unable to work. So this is also known as loss of time insurance, loss of income insurance, or an income replacement policy. Okay, next slide. Now, Typically, disability income insurance will pay around 60, sometimes up to 80% of your gross income. I'm going to explain why that's enough. So here you have your gross monthly salary, say it's $3,500, and you pay $1,200 in taxes, so your take-home pay is $2,300. Also, you don't have commuting or anything related to getting to work as well. So that means a 60% disability benefit that's tax-free that pays $2,100 a month is pretty close to what taxes would have taken out anyway. Now, is that super accurate? How much tax is taken out? It probably depends where you live. But basically, this is just a general example of why disability income insurance isn't always the full income amount. So basically, if you made $3,500 per month, your disability policy is not going to replace 100% of that. It's typically anywhere from 60 to 80%. So because disability benefits are tax-free, so you pay tax on the premiums. So 60% of the income gives you nearly the same amount of take home. And some benefits, some policies will pay a little bit more. So on disability, there are a few different things you want to take a look at here. So you become disabled right away and you can't work. So we're going to talk about the elimination period and the benefit period. I know these are a little out of whack here, but they're not lined up. But basically, day one, you can't work due to your illness or your injury. You are disabled. Okay, so you become disabled, and then there's something called an elimination period. So this is also known as a waiting period. It's just a fancy word for waiting period. So basically what happens is you don't receive any benefits during the elimination period. Okay, the longer the elimination period, the lower the premiums for the policy. So if you have a policy with a long elimination period, typically the premiums will be lower than a policy that has a short elimination period. This is because the insured or the insurance company, the insurer, takes on more risk. Because let's say you're disabled for 60 days, they have to start those payments sooner. And maybe someone, if it's a longer delay, someone's going to be more likely maybe to try to get back to work or something like that. Not saying anybody would ever milk their disability policy, but basically, pretty common is a 30, 60, or 90-day elimination period, as you can see on here. And with that being said, the elimination period, the shorter the elimination period, the more expensive the premium. The longer the elimination period, the higher the longer the period, the lower the premiums. And then benefits begin. And your benefit period is how long your benefits will be paid. So the shorter the benefit period, the lower the premiums. Sometimes they'll pay 2 years, 5 years, maybe only to age 65, or sometimes for your entire life. Okay, so we're going to cover something here about Social Security disability. So the myth is that Social Security disability will provide enough if someone becomes disabled. The reality is that Social Security has a very strict definition of disabled. So they must not be able to do any substantial work. So this means that they can't do any work at all. Like they are not able to really do anything. The benefits may also not be enough to meet that person's needs. So Social Security may not pay enough. So they might not qualify. The benefit might not be enough. It's a very long waiting period to get approved. One of my friends has some injuries, and it took him a long time to get approved. And he's totally like one of those people who, has physical injury, has to be on disability. And oftentimes claims are denied. All right. So Social Security disability is hard to get, takes a long time to get, claims get denied, and it often doesn't pay enough. So the right approach is to have Social Security as a supplementary income only. A personal disability plan, whether it's group or individual, should be your primary source of protection. So people should not rely on Social Security. They should have a group or individual. Next, we're going to cover AD&D insurance, accidental death and dismemberment insurance. So stay tuned. Okay, we are going to cover AD&D insurance, accidental death and dismemberment insurance. So it sounds dark, but AD&D, it fills a crucial gap in coverage. So this is another type of health insurance. Remember, there's 3 types of health insurance: medical expense insurance, disability income insurance, and accidental death and dismemberment insurance. So this is what AD&D actually covers. Benefits are paid if the insured dies from a car accident, a fall, workplace accidents, any accidental death. So any accident that results in death, or any death that results from an accident. Now, the dismemberment side of it, benefits paid for loss of one of these from an accident, a hand or a foot, arm or leg, loss of sight in eye or both eyes, and loss of body parts. So this is important. Accidental death and dismemberment. Why do I keep saying dismembership? Only covers accidents, okay? It does not pay for death from an illness, death from a disease, or medical expenses. Usually doesn't pay medical expenses, okay? So we're going to cover an important concept in accidental death and dismemberment insurance called the principal sum and the capital sum. So in the example that we have here, we're going to take a $75,000 accidental death and dismemberment policy. The principal sum is $75,000. This pays for accidental death, or it pays out in accidental death, loss of 2 limbs, loss of sight in both eyes, or loss of 1 limb and sight in 1 eye. So basically, you either got to die from an accident, lose 2 limbs, which would be terrible. I mean, like both arms or both legs, loss of sight in both eyes, or 1 arm, 1 leg, excuse me, loss of sight in both eyes, or loss of 1 limb and sight in 1 eye. Okay, now the capital sum is typically 50% of the principal sum. Sometimes I'll cover some variations below. Okay, so let's say the capital sum, which is 50% of the principal sum, is $37,500. This will pay for loss of 1 hand, loss of 1 foot, loss of sight in 1 eye. Okay? Or loss of 1 arm, loss of 1 leg. Oh, right here. Loss of arm or leg is typically 2/3 of the principal sum. So I almost made a mistake there. So loss of 1 arm or 1 leg is usually 2/3 of the principal sum. Okay? Now, this is super important. Okay, so accidental means is very restrictive. This means that both the cause and the result of the accident must be unintentional. So what this means, I'll give you an example here. If Maria, I'm going to zoom in. If Maria jumped off a balcony, even if it's a low balcony, and she severely injures her arm and it requires amputation, no benefit will be paid. This is also important for disability income insurance as well. So this right here, we're talking about accidental death insurance, but sometimes disability will look at accidental means versus accidental results. And sometimes they'll call accidental results accidental bodily injury. So under the accidental means definition, no benefit would be paid because she intentionally jumped. Right? She intentionally jumped. Now, if she was walking and something fell out of the sky and hit her in her arm, then that would qualify under the accidental means, right? Because the thing falling from the sky was not intentional. She had no idea what was going on. All right? It wasn't intentional. She didn't do it. She didn't take the action that resulted in the disability. The accidental results is less restrictive. I'm going to turn my AC fan on here. Okay. This is only the result needs to be unintentional. The cause can be intentional. So they're not going to hurt themselves on purpose. But in this case, Maria jumps off a balcony. She wasn't trying to hurt herself, but she did get hurt, right? I mean, most of the time, insurance companies assume someone wasn't trying to hurt themselves because most people just don't go try to hurt themselves, right? It's like not normal. So but sometimes people do it. They get mental health issues and stuff like that. So they will check. But she jumps off a balcony, severely injures her arm, requiring amputation. The benefit will be paid because the injury was unintentional, assuming that she didn't jump off trying to get hurt, right? Now, most states require policies to use the accidental results definition, making it more broad for policyholders. We're going to cover some time limits. So right here, I know these are a little skewed here. Maybe I'll have another version where the symbols fit, but this is just, it's in here. So accident occurs. Day 1. Maria jumps off the porch. I don't know why, but she does, and lands and hurts herself. Now, most policies require death within 90 days of the accident. So say she jumps off very high balcony. I don't know why, but she did. Maybe she was running from something. I don't know. Anyways, accident. Let's use a car accident. She's driving a car, gets in a car crash. She doesn't die. Maybe she doesn't die right away. So maybe she's not pronounced dead at the scene, but maybe she has some brain injuries and stuff that they try to get her back to good health. They just can't. So she ends up dying within 90 days. The death occurred within the time limit, so the benefit gets paid. So after 90 days, no benefit usually. Some states, the benefit might still be paid if they were totally and continuously disabled from the accident until death. So in some states, let's say, it may or may not apply to your state. They probably won't ask the specific of a question. But basically what it means is like if, say, Maria had a brain injury, she was just totally out of it, couldn't even leave the hospital for those 90 days. On day 91, she dies. In some states where they have to be paid if they were continuously disabled from the accident until death, it'll still pay out. All right. So next video, we're going to go into buying health insurance. Stay tuned. Okay. Next video, video 5, buying health insurance. So we're going to talk about 3 ways to get health insurance. There's individual insurance, there's group insurance, and there's government insurance. So which is the right fit for you or your clients? So we're going to cover some details here. First, individual policy. This is a direct agreement between you and the insurance company, the insurer. Some advantages: you own the policy. Okay. You can customize the benefit to your needs. Keep it even if you change jobs, and pretty flexible options. So this is the most customizable and like elite level plan is when you have your own. Disadvantage is usually it's more expensive than group policy. You get what you pay for. Requires an application process. You might need to go through underwriting and show that you are insurable and that you don't have stuff that may make you prone to a disability. And they may have to do some medical underwriting, maybe some blood tests, doctors, records, stuff like that. Short-term policies. If you're serious about passing your insurance exam on the first try or the next try, if you've already failed, I've got you covered. Click the link in the description to check out our pre-license courses with a 93% pass rate. We hope over 30,000 people per month get licensed, so let's make you next. Short-term health insurance policies are temporary coverage for gaps between jobs when you're waiting for a new policy. They're also called interim coverage or term policies, short-term, not term life insurance, term health. They are not renewable. It needs new application when it expires. So a short-term medical plan is something that is just short temporary coverage between you having those big policies that are really going to give you the full protection. Next, we're going to talk about group health insurance. So group policy, in a group policy, there's a master contract between the insurance company and the group. The group is the employer. So the business, the union, whatever, the lodge, like the Elks, or I don't know if there's Eagles, and I don't know. That's what they are back where I'm from. They're like, where older retired people go to drink and smoke cigarettes. I don't know. But that's, it's like a lodge, something like that, right? So lower premiums in a group policy because there's reduced administrative costs because they're insuring the group as a whole, not each person individually, right? So there's more work done on an individual policy because they have to look at that specific person. Whereas in a group policy, they're like looking at the group as a whole, okay? No individual underwriting, no medical exam, more liberal coverage provisions. So usually they're a bit more like the scope is wider typically. And the employer may pay part or all of the premium. Now the disadvantages are the employer owns the policy, not you. Okay, so the employer owns the policy. So if you have a disability policy with your company and you leave, you don't get to keep it. A lot of times. There's limited customization options. You may lose coverage when you leave, like I said, and the coverage is chosen by the employer. So you don't really it's like take it or leave it. It's like, hey, this is what we offer. Okay. And these are the groups that can offer group plans. So employers, labor unions, credit unions, trade associations, and other professional associations. So we're going to show here a diagram of how group policies work. So you have the insurance company, which issues the policy. And then you have the employer and the group that receives the master policy. So the employer, the group, owns and controls the whole contract. The employees and the members receive certificates of insurance, not the actual policy. Okay, so the employees or the members of the group receive a certificate of insurance. They don't get an actual policy. So pretty easy enrollment process. You fill out a form. You don't have to go through any underwriting or medical exams, but you have to enroll during the enrollment period. You can't just enroll willy-nilly whenever. There's a specific enrollment period. The group pays the premium. So usually the employer pays part or some of the premium. It can be a contributory as well with a payroll deduction. So non-contributory means that the employees do not contribute. Contributory means that the employees sometimes do contribute. So non-contributory is where the employer pays 100%. And a group policy typically is lower cost than individual policies because they are taking on the group as a whole, right? They're underwriting a whole group, which lowers adverse selection, and it's just the law of large numbers. Cool. Now we'll cover government health insurance programs. Okay, so there are a few here. So we're looking at Medicaid. Medicaid is a state program. So people who qualify for Medicaid are people on limited income assets or with limited assets, meaning you have to make below a certain amount of money and you can't have much money to your name. I know in Florida, at least with the last few years, you don't have to take these numbers exactly. This is just an example. So let's just not say Florida. Let's say a state, random state example may say, well, you can't make more than $20,000 a year and you can't have more than $2,500 in assets to your name to qualify for Medicaid. People receiving welfare also qualify for Medicaid. Blind individuals, people who are older, disabled individuals, and children under 21. Now we're going to cover Medicare. This is a federal program, so it's run by the federal government, which in this Medicare is for people over age 65, people with certain disabilities, people with end-stage renal disease, so kidney failure, might need dialysis, stuff like that. And it doesn't matter, regardless of income levels. So it's when you're 65 or older, regardless of your income level, you qualify for Medicare. And then the next type of government health insurance program is Social Security OASDI. So this is more like medical expense insurance. And then this is more like disability. So Social Security Old Age and Survivors Disability Insurance. I think that's what OASDI means. I'm like 99.9999999% sure. Disabled workers qualify. You must have work credits though. So either in this chapter or another chapter, we're going to be going over the credits to qualify for disability. There's a strict definition of disability. So like you can't do nothing. Like to qualify for OASDI, you gotta work. It takes a long time and you gotta prove like, man, I can't do anything with what I got going on. So we're going to talk about renewability provisions. So can the insurance company cancel you? So unlike life insurance, oh, wait, that's the next video. Sorry, you're going to have to wait. Don't skip the next video though. Thank you. All right, we're going to talk about a big part of health insurance, and these are renewability provisions. So renewability provisions are super important. And this has to do with if your insurance company can cancel you. So unlike life insurance, health insurance is not always permanent. Your insurer may have the right to cancel or not renew the policy. So there are some situations with health insurance where someone can have their policy canceled or not renewed. So we're going to talk about here the 5 renewability classifications from worst to best. So worst for the insured over here, best for the insured over here. Best for the insurance company over here, worst for the insurance company over here. Okay, so cancelable, the first one. Cancelable means the insurer can cancel you at any time with notice. So at any time they can cancel the policy. Second one is optionally renewable. So they can refuse renewal at the end of the period. So in an optionally renewable policy, at the end of your policy term, when you have the health insurance policy at the end of your, like the words slipping my mind now, but at the end of say you have a health insurance policy for a year, at the end of that year, they can refuse renewal for whatever reason. Cancelable is they can cancel it at any time. So you can get a call tomorrow and be like, yeah, we're not covering you anymore. Whereas optionally renewable, it's just once a year when you renew the policy, then they can decide not to renew. Conditionally renewable means that they can renew unless conditions are met. So it's like unless certain conditions are met, like certain life event or something like that, then you can renew it. Guaranteed renewable is you control renewal, but the premiums can increase. So you can always renew the policy, but the company can increase the premiums. And non-cancelable means they can't cancel or raise the premiums. So most health insurance policies, most medical expense insurance policies that you see through the ACA, the Affordable Care Act, are guaranteed renewable. So you can renew it every year, but those big premium hikes that you see are the company increasing the rate. And disability insurance is often non-cancelable. They can't cancel or raise the premium. Obviously, they can cancel if you miss your premium payment. So we're going to explain these a little bit more depth here. Cancelable, the worst. The insurance company can cancel at any time with proper notice. Very rare. So most of the time, these aren't even options anymore, and a lot of states have them not even allowed. Optionally renewable, the insurance company can choose not to renew at the end. I'll go over here. Not to renew at the end of the policy period. So you're at their mercy. Conditionally renewable is the policy can be renewed unless specific conditions are met, like you reach a certain age, you change jobs, and the conditions must be stated in the policy. Guaranteed renewable is you have the right to renew. The insurance company cannot cancel or prevent you from renewing it, but they can increase premiums. And non-cancelable is the best. The insurance company cannot cancel or raise premiums. As long as you pay your premiums on time, you're covered. That's typically the most expensive option. So the more favorable of the renewal, this is the cost versus protection trade-off, right? In any insurance policy, the higher the protection, the higher the cost. If you want a cheaper policy, you don't get as much protection. So the more favorable the renewability is for you, the more it costs. So this is just an example. If we go from cancelable to optionally renewable, conditionally renewable, guaranteed renewable, and cancelable, proportionally how the prices look. 30-day notice requirement though. Individual or blanket family hospitalization policies, so policies covering 10 or more people, must be renewable at the policyholder's option unless the insurance company gives at least 30 days written notice of non-renewal. Next, we're going to be diving into premium factors. So you don't want to miss this next video coming up. Stay tuned. Okay, so we're going to cover different factors in health insurance premiums. So why does health insurance cost what it does? Why is it so expensive? Hopefully it's not so expensive forever, but it is right now. This video might get dated. So why is health insurance so expensive? Let's follow the money. Follow the money. So we're going to cover first how premiums are paid. These are different payment frequency options. So you can pay health insurance annually, one payment a year, often the cheapest. Well, the cheapest per year, okay, because they don't have to process the payments each time, or every month. Semi-annual is 2 payments a year. Quarterly is 4 payments per year. And the most common option is monthly through automatic bank withdrawal. Key differences from life insurance. There are no limited payment plans. If you are not studying for your life and health insurance exam and just your health exam, I guess this doesn't really matter, but it's cool to know. But if you are, then you want to know this. So key differences from life insurance. There are no limited payment plans. Like life insurance and a whole life policy, you can have a 20-pay life, which is when you pay on the policy for 20 years and then it's paid up and you have insurance for the rest of your life. Also, no paid up at retirement options. So you can't just pay a policy until a certain age for health insurance and then you don't have to pay anymore and you still keep it. Premiums are paid year by year or month by month, and the rates may increase every year except with non-cancelable policies. So what determines your premium? So interest. So this is the insurance company's expected return on invested premiums. Higher returns means they can charge lower premiums. So the expected return is this. When you have insurance, when you make your payment every month, your insurance company doesn't just take that money and do nothing with it. They invest it to make a return on the money that you give them. So the more they can make on that money they invest, the lower your premiums need to be for them to make their profits, right? Next is expenses. So operational and administrative costs. things like agent commissions, they have to pay an agent for your policy, right? So that has to be factored into the cost of the policy. They have to process the claims. There's overhead for their office and technology systems. So there are operational and administrative costs of an insurance company. The biggest factor is morbidity, though. Oh, just cute little bacteria right there. So this is the expected rate of illness or disability in a specific age group over time. So this is like mortality in life insurance. In life insurance, mortality is what's the chances of someone in this given age group dying or certain health class dying. For health insurance, it's what's the chances of you becoming sick or disabled. And types of benefits that's what determines the premium. So the nature and extent of coverage. Obviously, the more benefits you have, the higher the premiums. Okay, and these are some personal factors that can affect your premiums in a health policy. Age, typically the older you are, the higher the premiums because you're more likely to need care. Gender may vary by gender, some depending on if there's different morbidity rates from gender to gender, or the chances of you getting sick. Occupation, if you have a riskier job, maybe higher premiums. Construction versus office work. Who's got more of a chance of getting injured? Someone in construction. Right? If someone works at home by themselves, they probably have a pretty low chance of getting sick unless they got kids and they bring home every disease under the sun or virus. But if they're at home by themselves, there's less exposure, right? And claims history. So what's the past claims experience? And this can be in the group, if it's group plan, or the individual. So what's the insurance company's payment history with whatever they're insuring? Important notice here. Factors combine to create your individual premium rate. The insurance company uses special charts called actuarial tables and statistics to figure out how much of a risk you are to determine appropriate pricing. So the bigger risk they think you are, the more money that your policy is going to cost. So we're going to look here at non-participating versus participating policies. So what this means, you have fixed premiums, no dividends paid, no profit sharing, and what you pay is what you pay. It's most common for individual health insurance. Now, sometimes common in group policies are participating plans. So what this means, they may pay dividends. So the insurance company may pay profits that they make on the investments that they make with people's premiums back into the policyholders, back to the policyholders in the form of dividends. They might use experience ratings as well to rate lower if there's a low claims experience. Right? If there's if they say it's in a group plan, they're like, man, no one at this company is filing claims for health or disability or accidental stuff. So we're going to lower their rates. And also potential refunds if claims are low. And sometimes you can also share in the company profits and get a check back. So experience rated groups, and that's in the form of dividends, the check. So life insurance policies, participating policies pay dividends as well. And we're going to talk about experience-rated group policies. These are premium adjustments based on a group's claims experience. So premium reductions may be applied retroactively for up to 12 months. What this means is, say you're paying $200 a month, and then they say, oh, you know what? You only used, there was a low claims experience in this whole group, meaning not many people use the insurance, so we're going to give you some money back. Maybe it was only supposed to be $180 a month, so we're going to give you back some money for the year. Typically, they may give it back to the employer, right? Because if the employer is covering insurance for everybody, then they give the employer money back. They say, hey, you didn't have many sick people. Y'all healthy, yo. We're going to give you some money back, and they give us some money back. Premium increases are never applied retroactively. Premium increases are never applied retroactively. Now, if expenses and claims are lower than expected, the group, which is often the employer, the association, whatever, gets a dividend or a refund. So either get a check back with some profits or saying, hey, you guys had a low claims experience, we're going to give you money back. Does that make sense? Same thing as say you let your friend borrow some money, right? If you're going to take that much of a chance, let your friend borrow some money. Just kidding. And they're like, hey, can I borrow $100? And you're like, yeah, that's fine. And then they go and they only needed 80. Now, a good friend would be like, hey, I only needed $80. Here's 20 back. That's kind of the same thing. So it's the health insurance company saying, hey, you have to pay us this much. This is how much it's going to cost us this year. And then at the end of the year, they're like, you know what, it didn't cost us that much. We're going to give you some money back. If expenses and claims are higher than expected, you don't get the group won't get a dividend or a refund, but they might get charged more after the next renewal cycle, right? So next video, we're going to cover some group health insurance to help you understand more in depth about group health insurance policies. All right, hopefully in this video, I can help you understand group health insurance, which is the most popular type of health insurance out there. We're going to give you maybe not everything you need to know, but a lot. And we're going to cover why most Americans have group health insurance. So here's the nature of group health insurance. Covered this a little bit already. The insurance company has the group policy. The employer receives the policy, has the master policy, and employees receive certificates of coverage. So there's like, hey, here you go. Here's a little piece of the pie, right? Employees get a certificate of insurance, not a policy. So if you have a group policy, you do not get a policy, you get a certificate of insurance, a benefits booklet, beneficiary information, and coverage details. For your enrollment period, there's a limited window to enroll. All eligible members can join. New employees have to complete an enrollment card, and there's typically a probationary period first unless you already had coverage within a certain amount of time after transitioning to the new plan. We'll cover that in a little bit, but it can vary by state too. So we're going to cover some characteristics of group health insurance. So eligibility standards for groups and individuals. Premium payments are typically contributory or not. I forgot what I had right there, but basically the group is underwritten. Premium payment contributory means the employee contributes some, or non-contributory means the employee does not contribute. The employer does pay for the whole thing. So in a non-contributory policy, the employer is paying the whole cost. Typically, the cost of group health is lower than individual policies. Benefits are predetermined and set by the employer. Typically, there's group underwriting. So it's not individual underwriting, it's underwriting for the group. When you leave the group, there may be conversion privileges for you to keep the policy when you leave. Preexisting conditions is often special provisions for preexisting conditions. If it's a Affordable Care Act plan, it has to follow. It has to cover preexisting conditions. And typically they have more liberal coverage than individual plans. So like more things are covered. So non-contributory, here we have employer pays 100%. It requires 100% participation. For all eligible employees must participate. Why 100%? Well, it protects against adverse selection and helps keep administrative costs proportional. Then we have contributory, where the employees share costs in payroll deduction. So 75% participation is required. At least 75% of eligible employees must participate in a contributory plan. Why? Same reasons: adverse selection and protection in administrative cost management. So basically, if the company's paying for it, you have to have it, because the insurance company doesn't want the only people who keep it are the sick people, right? Because if someone's super healthy and never files any claim, typically if someone's younger and healthy, they might not even put in the effort to get the plan because they're not going to use it. But the people who are older or get sick a lot, they will definitely want to use it. So if participation falls below the required threshold, the plan might be terminated, the master policy. So we're going to talk about here some benefits of group health plans for employers, so for the companies. They help boost employee morale. These contribute to positive work environments, and they enhance employee performance. There can be some cost savings for employees, valuable benefit if they'd otherwise buy with after-tax dollars, reducing wage increase demands. So sometimes you can use and have a payroll deduction for your health insurance premiums. Hiring and retention, group health helps make you be competitive to attract talent in the workplace or the workforce, right? So you say, hey, instead of you having to go pay for a policy on your own, I'm going to pay for it for you, right? People love free stuff. But the thing is, just want you to know, if a company offers you health insurance, it's not free, because they were either going to pay you more money and not give you insurance, or pay you this that and then give you insurance. So it does cost them money, right? So obviously that's factored into someone's salary, but they make it sound cute and pretty and make it sound cooler than it is. So it's like, hey, we're going to pay for your health insurance. That would normally, instead of giving you $400 a month extra, we're going to just use that to pay your health insurance. But I guess it's good because people who don't always buy it, they might use the money on other things. If you just give people money, sometimes they can do not the best things with it. Tax benefits. So the employer can claim tax deduction for planned contributions. So they can write it off on their taxes, meaning say the company makes $1 million in profit, but they paid $100,000 last year for their employees' health insurance, then their taxable income can drop to $900,000. So that can be the premiums that the employer pays can be deducted from their taxable income. Okay. Also, public relations, you sound cool and you look cool if you have benefits. We're going to cover cafeteria plans, section 125. I don't know why, but whenever I hear cafeteria, I think of school and I think of like those benches. We had tables, these low tables, and then you got the trays and you hear the trays clanging on the table. Everybody's got the same tray. I don't know. That's why when I hear cafeteria, I immediately think of that. So, but just like in your cafeteria where you can kind of pick stuff, the cafeteria plan, the employees can customize their benefits package by choosing from a variety of options, like selecting from a menu. So here's how it works. The employer allocates money. So they say, hey, here's a specific amount for each employee. The employee gets to select benefits based on how much the employer gives them. And if the cost of what the employee wants exceeds what the employer gives them, then the money can be paid with pre-tax dollars. So basically, let's say the employer says, we will give you $500 a month to use towards the cafeteria plan benefits. The employer goes and picks benefits that cost $600 a month. That other $100 difference, right? If it costs $600, but the employer pays $500 of it, that $100 difference that the employee has to pay can come out of the pre-tax income. So it comes out of money like before that income is taxed. Same thing as the way that the employer has tax deductible premiums. Common benefits, disability. So common benefits to 125 plans are disability insurance, medical insurance. So like health insurance, medical expense insurance. What we consider health insurance, I guess, nationally, but it's covering hospital visits, surgeries, inpatient, outpatient care, stuff like that. They can often have life insurance, accidental death and dismemberment insurance, AD&D insurance, and dependent care. So to help take care of people that are dependent. This is Section 125 of IRC of the Internal Revenue Code. That's why people call it Section 125 plan. So the S corporation owners with more than 2% stake are not eligible to participate. So basically, if you own the S corp 100%, if you own the corporation 100%, then you can't participate in the benefits. Okay, what the heck? Okay. What groups are eligible for group health coverage? So you must be a natural group. So the group must be formed for a purpose other than obtaining insurance. So you can't get some of your buddies together and be like, yo, bro, let's all like chill and get insurance. No, it has to be formed for something else. So that's why you can have an employer, trade associations in the same industry, labor unions, creditor-debtor groups like credit unions, stuff like that. Lodges, like I said before in one of the videos, like Elks, Moose Lodge, Eagles, stuff like that. And then multiple employer trusts. So we'll get into some of those MET stuff at another point. Next video is going to be on COBRA, which will help you keep your insurance if you lose a job. So you want to watch this next video too. All right, so today in this video, we're going to be covering COBRA. So COBRA is what happens to your health insurance when you leave your job. I think it stands for Consolidated Omnibus Reconciliation Act. We will, I'm sure, find out in this chapter, but this is an important chapter, an important concept, I guess, for your health pre-license exam. So basically, COBRA is it helps you keep your insurance if you leave your job, your health insurance. So, yep, I was right. Consolidated Omnibus Budget Reconciliation Act of 1985. So we're going to cover some requirements here, some key provisions of COBRA. So it applies to employers with 20 or more employees. Who gets COBRA? Laid off employees, not terminated for cause or gross misconduct. So if someone loses their job because they got laid off, then they would qualify for COBRA. But you can't qualify for COBRA if just because you got fired or something for cause. The employer must explain continuation privilege to the terminated employee. So when that person gets laid off, then the employer must explain how they can continue their insurance. The election period. So terminated employees have 60 days from being terminated to elect COBRA. And who pays? The former employee pays the full cost up to 100% to cover administrative costs. So the employee gets to keep their health insurance, but they have to pay for it. Okay. So we're going to cover some COBRA details or coverage periods. So the qualifying event coverage duration, the employment is terminated. If it's not for gross misconduct, they have it for 18 months. If they have it for 29 months, or 29 months, I feel like this should be organized a little different. So I guess they have it for 29 months. Oh, okay. Yep. So this should be here. This is just offset a little bit. But basically, they say they have their employment terminated not for gross misconduct. They have it for 18 months. And then they have it for 29 months if they're disabled. This is the reason here. So say they just get their hours reduced and they no longer qualify for the plan. So say they go from full-time to part-time. All right. They go from full-time to part-time. They may no longer qualify for the plan. Okay. So that means that they still, same thing, 18 months or 29 months if they're disabled. Now, if the employee dies, then the dependents keep it for 36 months. If there's a divorce or legal separation, then the spouse, the person they divorced from, keeps it for 36 months. And if a dependent child ages out, then they have it for 36 months after. And if the employee is eligible for Medicare, then they can keep it for 36 months. So ex-spouses may qualify to convert an individual policy if they don't remarry before reusing the conversion privilege. So basically, if you're studying this, the order is, this is the reason, this is the qualifying event, and then this is the coverage duration. Okay, 18 hours, 29 if disabled. Hours are reduced because they go from full-time to part-time, then they have it for 18 months or 29 months if they're disabled. If the employee dies, dependents keep it for 36 months. If there's a divorce, the former spouse keeps it for 36 months. And if the dependent child ages out, then they keep it, that dependent child can keep it for 36 months. And if they're eligible for Medicare, they can keep it for 36 months. So some of these slides are just a little off here, but it's okay. We'll cover it. So what it is a conversion privilege. You can continue group coverage and convert it to an individual policy. Okay. You get the same group benefits. However, it's an individual policy benefit. Duration is 18 or 36 months. Or permanent for temporary or permanent as long as premiums are paid. The cost can be up to 102% of the group rate. Individual policy rates are usually higher. So when do you use this? To bridge coverage between jobs, or if you have long-term individual coverage needs. So HIPAA requires group insurance carriers to offer option of individual plan after COBRA expires. Okay, so after COBRA expires, the insurance company needs to offer an individual plan. So if you see there where I was mentioning that after COBRA expires, they can get an individual plan. That's because the insurance company will offer them. So like after this, 18 or 36 months, then they can buy an individual plan if they want it as well. So here's some COBRA exclusions and when benefits end. So common exclusions: continued group coverage may not include dental services, vision care, or prescription medication. So a lot of times dental, vision, and prescriptions are excluded from COBRA, and COBRA ends when the employer terminates all group health plans, or the premium's not paid, or you become covered by another group plan, or the maximum period expires. So basically, if the employer that you were working with terminates all their group health plans, then COBRA could end for you. If you don't pay your premium, then obviously your insurance could end. If you become covered by another insurance plan, then your COBRA could end. And if the maximum period that you have that COBRA, remember, was 18 or 29 months or 36 months, depending on the different variations there, and then that's when COBRA could end. And after COBRA, the eligible employee can convert to an individual health policy within 180 days after continuation period ends. So after COBRA, you can convert to one of those individual options that the health insurance company is supposed to give you for up to 6 months, so 180 days. So say you get terminated for, you didn't do anything wrong, you just get laid off. Then you can extend the coverage with COBRA for 18 months. COBRA will cover you for 18 months. After that, the individual company offers you, the insurance company offers you an individual plan, at which point you have 180 days to convert and keep that plan. Your dependents are protected though. So dependents are not required to prove insurability when exercising continuation or conversion privileges. So this makes sure that if someone gets laid off, their family doesn't end up with no health insurance. Next video, we're going to be covering HIPAA and what this means about pre-existing, how this helps people if they're switching jobs and maintaining coverage for pre-existing conditions. Okay, welcome to the video. We're going to be covering HIPAA and what it has to do with portability and privacy for health insurance policies. So changing jobs used to mean that you lost coverage for pre-existing conditions, meaning say you're diabetic and you were working one job and your health insurance covered your insulin and all your other conditions that you may have, or all the other things you needed for your diabetes. If you switched, if you lost a job and then changed, or maybe you changed jobs, you went to another job, your new insurance might not cover your diabetes treatments and medications because it was a pre-existing condition. So we're going to cover how HIPAA changed that. Big deal. This is really important for people who have those conditions, who need that coverage. So HIPAA privacy rules. So first, we'll talk about the privacy rule. So HIPAA safeguards health information. So it's a federal safeguard for your health information to make sure it's private. So protects people's individually identifiable health data, right? Because there's some health data that will identify you as an individual that like nobody else has, right? It matches you. It gives patients rights over their health info, and it sets boundaries on the use and release of health information. Now, the HIPAA security rule are technical safeguards for electronic health information. So it ensures confidentiality, ensures integrity, and ensures availability. So the HIPAA privacy rule kept your information private. The HIPAA security rule made sure that there had to be technical safeguards and make sure that the systems were in place to make sure that people's information was private. Protected healthcare information. Healthcare providers must comply with requirements for disclosure of protected health information. Policyholders must be notified of information practices at least every 3 years. So you'll see when you write policies, there's usually some sort of HIPAA disclosure statement or protected health information, and it just explains what's done with your information. It's just a typical government, disclaimer. So HIPAA key requirements. So you for continuation of coverage, employers with more than 20 employees must permit former employees to continue health coverage from the employer's group plan. Okay, so employers with 20 or more employees must allow former employees to continue coverage from the employer's group plan. Another key requirement is that there can't be any discrimination. So group health coverage cannot base eligibility on medical history, health status, disabilities, claims experience, or genetic information. So medical history. So they can't base eligibility on someone's previous treatments or what they have been treated for in the past. They can't discriminate based on what their conditions are now. They can't discriminate on whether that person has any disabilities. They can't base eligibility on how many times someone has filed claims for health insurance in the past. And they can't base eligibility on someone's genetic makeup. So if you have someone has a DNA test that says that they are predisposed to a bunch of different things, then HIPAA does not allow coverage to discriminate based on that for group health. Also, it requires for immediate coverage upon hire. So if an individual leaves one employer and starts at a new company offering group health insurance, eligible coverage they're eligible for coverage immediately upon hire. So if they leave one company that has group health and they go to another company that has group health, the coverage starts immediately. And there's a IRA withdrawal penalty. So 10% early withdrawal penalty does not apply for medical expenses exceeding 10% of the adjusted gross income. So basically, if you have an IRA, if you have an IRA, it's an individual retirement account. It's an account that you can put money in before it's taxed so that it grows tax deferred, meaning you don't pay tax as it's growing. And then you pay tax on the money when you retire, and you make those withdrawals. However, you can't withdraw before a certain age. If you do, then you have to pay that tax plus a 10% withdrawal penalty. This penalty does not apply if it's used under HIPAA. The penalty does not apply if it's used for medical expenses that exceed 10% of your adjusted gross income. So say your adjusted gross income is $100,000 and your medical expenses are $11,000, then that's more than 10% of your adjusted gross income. So keep in mind, these percentages may change over time. So this is as of 2025, but if you're watching this and you see any of these numbers change, just send us an email and let us know, because some of these things may adjust and change over time, and it may happen faster than we're able to go change one little thing. We have hundreds of thousands, millions of pieces of information in all these courses. So please help us help you and help other students. Where, hey, if you see something that's out, like a value that's outdated or something, just reach out and let us know. That way we can change it. Okay, pre-existing conditions. But with that being said, 99.99% of the material in here is going to be factually accurate. All right. So usually those don't change too much, but every now and then there can be, Congress might pass a new law that changes something, and our systems are not directly connected with Congress, obviously, right? So sometimes things may change and we need to change it. And you may see it and get, see it before we actually get the notification that it changed. So pre-existing conditions under HIPAA. So HIPAA portability, this allows individuals to reduce or eliminate pre-existing condition exclusions when switching group health plans. So like I said before, we'll use the difference or the example, say someone has high blood pressure and they leave one group health plan and go to the next. In the past, that new plan might not cover the pre-existing condition, but now it does, thanks to HIPAA. So a pre-existing condition definition is health conditions that existed, were treated, or were diagnosed within 6 months leading up to employment. Regular enrollees have a 12-month maximum exclusion period. So what this means is a regular enrollee is if someone did not have a previous group health plan and now they are enrolling in a new group health plan. So say they start a job and they have this new group health insurance plan. A lot of plans will actually cover pre-existing conditions now because most employers will pick a plan that will cover pre-existing conditions, or usually pre-existings are covered, or there might be like a short time period where it's not, but they can exclude those pre-existings for up to 12 months legally. And late enrollees can have up to a maximum 18-month maximum exclusion. So this is where, so someone starts working. And if you remember in one of the previous videos, we talked about how people have to enroll in their health insurance by a certain time. Okay. So they have to enroll by a certain, when they start a job, they have a certain amount of time to enroll in their health insurance coverage. If they don't, they're considered a late enrollee. And the exclusions can last longer because the health insurance company doesn't want people to wait until they're sick to get health insurance, right? Okay, so we're going to talk about creditable coverage in the 63-day rule. So creditable coverage is previous coverage that reduces the waiting period for pre-existing conditions when switching plans. Remember how I talked about how HIPAA allows people to go from one plan to another, that one group employer plan to another group employer plan without losing coverage. So day one, prior coverage ends. last day of previous health insurance. There's a 63-day window. So they need to start the coverage within 63 days to maintain creditable coverage. They need to start their new plan within 63 days to maintain creditable coverage. Okay. So if they wait more than 63 days, the previous coverage does not count as creditable coverage. If they do it within 63 days, the previous coverage counts. This reduces or eliminates pre-existing condition waiting period. So this waiting period we showed here, these 12 months or 18 months, this is waived if they had coverage, creditable coverage within the last 63 days. Okay. All right. So next we're going to be talking about dental and vision coverage and how they work differently. Okay. So today we're going to talk about dental and vision coverage and how they work a little bit differently. So dental and vision coverage work differently than your regular medical expense insurance. Here's how. So for dental coverage, you have scheduled versus non-scheduled plans. For a scheduled plan, you can have a basic plan where it has no deductible. A scheduled plan is a basic plan, very basic. So no deductible. Means you don't have to cover any of the cost with the insurance company. There's really no cost sharing. There might be a copay, but there's no deductible or co-insurance cost sharing. It has first dollar coverage. So first dollar coverage means from the first dollar that you are billed at the dentist office, the coverage kicks in. So you are covered from the first dollar coverage. Now, sometimes first dollar coverage, though, doesn't give you maximum benefit. So a lot of times, first dollar coverage where there's no co-insurance and no deductible doesn't have as comprehensive as benefits, which we'll get into in a second with non-scheduled plans. But the reason for that is because the insurance company says, okay, well, we're going to cover the first money that if you go to the dentist and say you need a cleaning, maybe we'll cover the cleaning and a filling. But if you decide you want to get, your whole teeth, your whole mouth redone and get false implants, we're not going to cover the whole thing. That's where co-insurance and deductibles will go and remove risk from the insurance company. Because if someone has first dollar coverage and no deductible and comprehensive coverage with no deductible or no co-insurance, they can go in and just rack up this huge bill that the insurance company has to pay. However, if there is a deductible and co-insurance, then the person, the patient, might be more likely to be like, yeah, I'm not gonna go do this because I have to pay for some of it too. Does that make sense? Can't get something for nothing, except first dollar coverage. And there's a set schedule of benefits. So maybe it'll be like, okay, we'll cover 2 cleanings a year and 2 fillings a year up to $150 for each filling or something like that. And then you have to pay the rest. Then we have comprehensive plans, which are more common, which are non-scheduled plans. So these require deductibles. They require co-insurance. And they're based on UCR, which is usual, customary, and reasonable, which means that the pricing is based on the rates that are usual, customary, and reasonable in your geographic area. It's also called a usual and prevailing plan. Okay, so we're going to talk about the dental insurance co-insurance structure. So preventative care, like cleanings, fluoride treatments, x-rays, and exams. Okay, so you get a cleaning, fluoride treatment, you bite down on the spongy things, they put that foam in it. X-rays, we know what x-rays are. You bite down on the thing and then they take pictures of your teeth. And then exams, so dental exams. Preventative care typically has no deductible or no co-insurance because they want people to go get preventative care to make sure that you're doing routine thing. An ounce of prevention is worth a pound of cure, the saying is, right? So this is like prevention. What can we do to make sure that teeth stay cleaned, they stay treated, that they're examined, and that we can recommend the patient to do things so that they don't end up needing to get all these other services. Basic services. Typically, the plan pays 80%. So fillings covers 80% of fillings. You're responsible to pay 20% of fillings, 20% of the simple extractions, 20% on root canals, and 20% on periodontal work. So fillings is when you have a cavity and they put a filling in. You probably know what a filling is. Simple extractions is when they need to remove a tooth, and it's pretty simple of a procedure. A root canal is when they drill in through the root of your tooth and they put a post and then I think they put something on top of it. I believe so. I'm not a dentist, but I think that's what it is. They put like a crown. And then periodontal work is gums. So if you have like receding gum lines and stuff like that, then they may need to do gum grafts or something, and that could be covered with periodontal work. Now, the major service is 50%. The plan pays 50%. So crowns. So maybe you get your root canals 80% covered, and then the crown that they put on it, you have to pay 50%. Bridges, you have to cover 50%. I don't really know what bridges are. Let me look it up real quick. So, yeah. So what it does is it's when you replace a few teeth. So bridges has to do with replacing one or more teeth by anchoring an artificial tooth to another tooth next to it. Okay. Dentures, we know what dentures are, or dental implants. So these are major services that typically 50%. So benefit limits, usually there's a calendar year max. This is just an example. This is what most follow, but this is an example. Some may be different. Benefit limits, calendar year maximum. So example, there might be a $3,000 maximum benefit limit. So the insurance company might pay a maximum of $3,000 per year for dental services. And there might be a lifetime maximum for specific services, like $2,500 lifetime maximum for orthodontics. So we're going to talk about some dental exclusions and predetermination. So services provided by government agencies are excluded. Cosmetic procedures, unless required due to an accident. So like dental, veneers, you're not going to get covered by insurance. Treatments covered by workers' comp. Duplicate dentures or replacement of lost or stolen dentures. Exotic procedures like splinting or occlusion restoration. Not sure what those are, but just know any crazy procedures that maybe don't need to be done. Oral hygiene instructions. Emergency services outside of network. They may be limited. And replacement of prosthetic appliances within 5 years of benefits last paid. So prosthetic appliance might be a denture. So this is basically saying like you can't go, if something else covers your dental, then the insurance is your health insurance isn't going to cover it, or your medical expense insurance. Well, your dental and vision won't be covered if another type of insurance covers it, or you're getting some sort of like exotic procedure, cosmetic procedure, something that's not medically necessary. Many plans require predetermination. So it's like a prior authorization. But for dentistry, they call it predetermination. But in health and for your medical expenses, it would be called prior authorization. Remember how we talked before about if someone needs a procedure done, like a surgery, they need to get prior authorization. That way they just don't get all these procedures done and then bill the health insurance company. And then the health insurance company is like, well, you didn't need to get your appendix removed, but you went and got it anyway. So this review ensures treatments necessary and reasonable. So services will be covered even without pre-certification, but the dentist and insured won't know specific benefits in advance. Now we're going to talk about vision coverage. So vision coverage typically covers eye exams, eyeglasses, either partial or in full, contact lenses, partial and full, fittings, so getting your lenses fitted, and other corrective items. Example, there's often restrictions, like you can get new frames every 2 years usually. Typically, what's excluded with vision care is eye disease treatment. Usually that's your medical expense insurance is going to cover that. Safety lenses. So if you're like a construction worker, you're like, hey, I want new safety goggles. Your vision care usually won't pay that. Eye surgery will be medical expense. Prescription sunglasses, those are considered luxury, although you can get like transition lenses a lot of times. Plastic lenses, those are more expensive, so typically they're excluded. Frame upgrades and LASIK surgery usually is not included. Okay, so frame upgrades, so like you can't get the Gucci frames, you got to get like the regular ones, right? I'm gonna look, why are plastic lenses excluded? You figure it'd be cheaper from vision insurance. Okay. So this is saying that you can't get like double lenses. So plastic lenses often are covered, but you can't get like, I'm going to get glass lenses and plastic lenses on top of it. All right. So this is just saying like if you wanted additional lenses, you just get the one set of lenses. Okay. So next we're going to talk about coordination of benefits. So if you have 2 health insurance plans or 2 medical expense insurance plans, 2 accidental death plans, well, those will pay out, but 2 disability plans, 2 vision, 2 dental, who pays first? We're going to cover that in the next video. Okay, so coordination of benefits. So if you have 2 plans, who pays first? So this has to do, coordination of benefits, COB, determines who pays first. If you have 2 health insurance plans, 2 medical expense, whatever, this determines who pays first. So what is coordination of benefits? Coordination of benefits is found exclusively in group health plans. This prevents duplication of benefits and overinsurance when the insured has coverage under multiple group plans. So this prevents overinsurance. Okay, so make sure that someone is not insured for more than, we don't want them to be restored to more than the state they were in before the claim, before the loss. Remember how we talked about the principle of indemnity. So this protects the principle of indemnity so that if someone has, say they have 2 disability insurance plans, they're not going to get more money being disabled than when they were working. So how it works, we're going to talk about medical expense insurance here. You incur $900 in medical costs. So say you go to the hospital, they say it's $900. Your primary plan pays first. Secondary plan pays the remaining. The total from all plans is less than or equal to $900. So the total from all the plans cannot exceed the actual costs that you incurred. So this ensures that total payments don't exceed the allowable medical expenses, so that you can't profit from your insurance claims. Here's some examples. We're going to use a married couple example. Jacob and Kathy are married. Oh, so cute, Jacob and Kathy. Each has their own employer's group plan. So they each have good jobs, they each have health insurance, and each is covered as a dependent under their spouse's plan. So Jacob's primary plan is Jacob's plan. His secondary plan is Kathy's plan. For Kathy, her primary plan is Kathy's plan. Her secondary plan is Jacob's plan. So basically, if Jacob's primary plan would cover first, and then if there were other benefits that needed to be covered that the primary plan wouldn't cover, the secondary plan would kick in as long as it covers those losses too. Same thing with Kathy. Dependent children goes by the birthday rule. So for dependent children, the primary plan is the parent with the earlier birthday in the calendar year. And the secondary plan is the other parent's plan. So example, mom's birthday is March 15th and dad's birthday is July 22nd. So the mom's plan is the primary for the children. I don't know why they did that, but kind of I wonder if it's on the same day, how they do that. I don't know. Maybe they got to get the times or something. But the primary plan is the parent with the earliest birthday in the year. So it's not the youngest parent. It's just the parent who in that year whose birthday comes first in the calendar year. So we're going to talk about coordination of benefits with Medicare too. So workers age 65 plus with group plan in Medicare. So if they have a group health insurance in Medicare, the primary payer, the group health plan, pays first. And the secondary payer, the Medicare, pays second. Okay. So this excludes work-related injuries and illnesses. So basically, if you're over 65, you have Medicare and a group plan, the group health plan pays first and Medicare pays second. So there's something called the Medicare carve-out. So sometimes group plan benefits may be reduced if Medicare pays for same expenses. Okay? In these cases, Medicare pays first and the group plan covers portion of remaining costs. So some group plan benefits might be reduced if Medicare pays for the same expenses. So this is saying Medicare might carve out some of those benefits, where in this case, Medicare would pay first and the group plan would cover the remaining costs. So next video, we're going to cover group disability income insurance plans. Okay, we're going to talk about group disability income plans and how they're different from individual plans. And here's what makes it unique, because they do work a little bit differently. So let's dive into this. So this chart, we're looking at the difference between individual disability and group disability, and the differences in some of the features. So here we have the benefit amount. For individual disability, it's a flat dollar amount that is specified when you purchase the policy. Whereas with group disability, it's typically a percentage of earnings. Medical underwriting is required for individual disability policies because you're going to the company and you're saying, hey, look at me and I need you to insure me. Whereas in a group plan, you're part of the group and the group is being insured as a whole. So you don't have to go under individual underwriting. For individual disability, it pays the full benefit regardless of your income. All right. So of other income, whether you get Social Security or other income, this full benefit pays with the individual. But with group disability, it's coordinated with your other benefits. So if you get Social Security or workers' comp, then group disability coordinates with that. So it lowers their liability. With individual disability, you own it. So no matter what happens, you keep it. And with group disability, your employer owns it. So if you leave the company, you don't always keep it, which here, portability, it goes with you no matter what. But group disability, you may lose it if you lose your job. Okay, so short term, we have duration, maximum 13 or 26 weeks. Payment, weekly benefits, and the benefit amount, 50 to 100% of income. So short-term disability covers 50 to 100% of your income. It lasts for 3 to 6 months, which is 13 to 16 weeks. 13 to 26 weeks, and it pays you every week. So it just tries to help supplement that short term, like, hey, you're used to getting paid every week. Here's your weekly income. Long-term disability pays for 2 or more years, and it's got a much longer duration than short-term. Sometimes it'll pay all the way until retirement age. Typically, it pays out the benefit monthly, so you get one check per month rather than one check per week. And the benefit amount is often capped at 60% of your income, which before, as you've seen, 60% of the income is typically all people will need since their main income was taxed. So this is the disability benefit they will get tax-free. So if both short-term and long-term provided, long-term benefits begin after the short-term benefits end. So if you have both short-term and long-term, the long-term begins after the short-term ends. Now, we're going to talk about the definition of disability and benefit coordination. So the definition of total disability in long-term plans is your year 1 to 2, can you not complete your own occupation? So that means, are you unable to do the duties of your own job? And then after years 1 to 2, they go by an any occupation definition. So you're unable to perform duties of any occupation for which you're reasonably suited from education, training, or experience. So at first, it's, hey, can you not just do your own job? And then after, it's, are you not able to do any job at all? Group disability benefits are typically coordinated with Social Security disability, workers' compensation, pensions, and other social insurance. So your benefit from group disability may be reduced by payments from these other sources to make sure the total amount you're getting doesn't exceed a certain percentage of your regular earnings. So they are trying to just make sure that you don't go without, but they're not. Group disability isn't really going to make you more money than before your disability. With military instatement, military personnel are entitled to reinstate group disability coverage once released from active duty. All right, next we're going to moving on to video 14, which is on limited and special risk policies. Okay, video 14 of this series, we're talking about limited and special risk policies. So these are policies that don't cover everything. They're very, very limited and special. So these don't cover everything, and that's by design. So we're going to cover some parts here. Limited benefit policies are also called voluntary benefit policies. They have restrictive coverage amounts or focus on specific range of risks and losses. A notice to insured is required whenever you sell someone a limited benefit policy or limited risk. State insurance departments require a notice informing policyholders that they're purchasing a limited benefit policy. So they must be made aware that, hey, this policy is only going to cover certain things. Some are accidental injury only policies, so benefits for expenses from accidental injuries only. Some are specified disease policies where they pay a set amount for specific diseases or impairments. Some are have coverage for specific limited healthcare services, and a lot of them are indemnity policies with predetermined dollar amount per day. So we're going to look at specified disease and critical illness policies. Specified disease are also called dread disease policies, and these cover specific illnesses like multiple sclerosis or kidney failure. So a specified disease is a specific disease. Multiple sclerosis, kidney failure, something like that. It gives us fixed dollar amount for specific risks. And it covers specific medical treatments for those, like dialysis, hospitalization, something like that. So critical illness covers specific conditions. It'll cover things like organ transplants, heart attacks, advanced kidney failure, strokes, sometimes Alzheimer's or loss of sight, right? How critical illness works. It gives a lump sum payment paid directly to the insured upon diagnosis and survival of covered illness. You can use it for non-medical expenses. It doesn't have to be for medical expenses. It can be for gap coverage for any existing medical insurance. And it can really be for any purpose that the insured chooses to use. So they can use it for anything. So the difference between a specified disease and a critical illness policy is that a specified disease policy or dread disease policy just covers one thing. Like it'll be like, we're only going to cover you for kidney failure, right? Critical illness will cover a wide variety of illnesses. So it can be like 10 to 30 different things that could be covered under a critical illness policy. Specified disease policies will typically cover will cover medical treatments for that specific disease. And critical illness will give a lump sum payment. So critical illness is typically like a valued contract. Specified disease are often indemnity contracts where it covers the medical treatment. Okay. Often in a critical illness policy, there can be a waiting period, like 30 to 90 days. And the policy ends after the payout with a critical illness policy. A specified disease policy does not end after the person gets coverage for that disease. So, hospital indemnity and prescription drug plans. Hospital indemnity plan is also called a hospital income plan. Indemnity means restoring you to the position you were in before the loss. And hospital, put them together, obviously. Well, what I'm thinking is if you go to a hospital, and there it is. It provides a stream of income during hospital confinement. Starts the first day of confinement until you get discharged. Pays a set amount daily, weekly, or monthly. And it's paid direct to the insured. So they say, we're going to give you $150 for every day that you're hospitalized. They pay the insured directly rather than paying the insurance company. Rather than paying the healthcare provider. And this is based only on days confined, and it's not related to medical expenses incurred. So hospital indemnity plans have nothing to do with medical expenses incurred. They just pay you if you're in the hospital. In prescription drug policies, they cover medications dispensed outside hospital or extended care. So these are not medications you get while you are being treated. They're like outside. There's a formulary, which is a list of covered drugs. And they're categorized by class and purpose, price, class, and purpose. So there's generic drugs, brand name drugs, and specialty medications. So say generic drugs will be like diphenhydramine. That is Benadryl, generic, right? That's the actual chemical. And then if you wanted the actual brand name of Benadryl, the allergy medication, then it might cost more to get the actual brand name. And then your specialty medications. Like there are special medications that come out all the time for really tough illnesses like HIV, AIDS, dementia, Alzheimer's, stuff like that. There are always specialty meds coming out for those things. And the prescription drug policies usually require a copay. They generally don't cover non-prescription drugs. So in this instance here, I know I talked about Benadryl. Benadryl is a non-prescription drug. So usually that wouldn't actually apply, but I just wanted to give you an example of a generic versus a brand name drug. Okay. Generally, what's not covered are non-prescription drugs except for injectable insulin. devices or appliances, hypodermic needles, administration fees, sexual dysfunction, or for infertility meds unless required by state law. Okay, so these are typically the coverage for prescription drug plans. Now we're going to look at limited risk versus special risk policies. So limited risk has coverage for limited risks, kind of straightforward. And a special risk has coverage for unusual hazards not in standard policies. Okay. So an example of a limited risk policy can be a tourist buys accident insurance at train station to cover a specific train journey. So say, you know how like sometimes if you rent a car at the airport, they ask you to buy their insurance, then that's like a limited risk policy. Like, hey, we're only going to insure you during this time that you have our policy. Now, I know that's property and casualty insurance, it's car insurance, it's not health insurance, but same thing. Say you were like, okay, I want to have my injuries covered while I am renting this car. Same thing. Special risk could be like a professional dancer insuring their feet for $2 million, or a race car driver insuring his life during a high-speed race. So that's like super particular, specific, like weird things to insure. Scope is specific perils, losses, or circumstances that are narrowly defined. And the special risk covers unusual or exotic risks beyond standard coverage. Duration is often temporary or event-specific for a limited risk, and a special risk can be temporary or it can be ongoing. So if you look at the key differences here, limited risk is limited in scope, like it's only during a train ride, a specific duration. But a special risk is it's unusual, right? Like it's normal for someone to take a train, but if someone's driving a train at 700 miles an hour, then that's not normal, right? That's a special risk. Okay, next we're going to be getting into the Affordable Care Act. Okay, we're going over the Affordable Care Act. The ACA is a big deal when it comes to medical expense insurance and health insurance. So we're going to talk about the different metal tiers that are in the ACA. So we have bronze, silver, gold, and platinum. These have to do with the co-insurance. So the bronze has a 60-40 co-insurance. The silver has a 70-30 co-insurance. Gold has 80-20, and platinum's 90-10. That means the insurance company pays 60% here, and you pay 40% of co-insurance. So this is after the deductible is met and the copay is still required. Okay, so we're going to go over 10 essential health benefits of the Affordable Care Act. So there are 10 things that that medical expense insurance policy must provide. These are known as the 10 essential health benefits of ACA plans. You can with no lifetime or annual cap. Okay, so number one is ambulatory patient services. This is healthcare without hospital confinement. Walk-in clinics, physicians' offices, outpatient surgery centers where you go in a day and you leave the same day. They must provide benefits for emergency services, which is urgent medical care where immediate treatment is necessary to prevent severe disability or death. There must be hospitalization coverage, inpatient care, including room and board, nursing, physician services, diagnostics, medications during the stay. Must cover pregnancy, maternity, and newborn care. So ongoing care during pregnancy, childbirth, all that stuff. And mental health and substance use disorder services. So there must be benefits for mental health, evaluations, diagnosis, and treatment of mental health and substance abuse conditions. Part 2, the next 5, there must be benefits for prescription drugs, which are medications prescribed by a healthcare provider. There must also be benefits for rehabilitative and habilitative services, so services and devices to help people recover, gain mental and physical skills after injury, disability, or chronic condition. There must be benefits for lab services like diagnostic testing of blood, tissues, bodily substances, all that stuff. There must be benefits for preventative wellness and services like routine care, so screenings, physical exams, immunizations, chronic disease management like asthma, diabetes. And there must be benefits for pediatric services, so care for insured children, including pediatrician care, dental care, and vision care. Note on adult coverage, while limited pediatric dental and vision benefits are required, adult dental and vision coverages are optional and typically come with additional premiums. So children, there must be dental and vision care for kids, but for adults, it's optional. Now we're going to talk about dependent coverage under the Affordable Care Act. Dependent coverage. So eligible dependents. A dependent is someone who depends on someone else for money or home or housing, stuff like that. So spouse, if not legally separated, and dependent offspring, married or unmarried, up to age 26. So those are natural born children, adopted children, and stepchildren. Coverage starts if the covered employee gains new dependents through marriage, birth, or adoption. These dependents are eligible for coverage starting from the date they become dependents. Okay, so from the date someone becomes dependent, they are eligible for coverage from the person they depend on. Now, under the Affordable Care Act, there is a marketplace for people to get their insurance coverage. To enroll in health coverage through the marketplace, you must meet all these criteria. You must live in the United States. You must be a U.S. citizen, national, or lawfully present non-citizen. You must not be incarcerated, and you must not be on Medicare. This is a quick reference for the ACA. There are 10 required benefits that they cannot put lifetime or annual caps on. You want to review those. There are different metal tiers for the Affordable Care Act. Bronze, silver, gold, platinum. Remember, 90-10 is the highest, 60-40 is the lowest. Children are covered up to age 26. Pre-existing conditions cannot be denied. You can't be charged more because of pre-existing conditions. You can get insurance through the marketplace. It's healthcare.gov. This is an exchange where you can shop for ACA compliant plans. And vision and dental is optional for adults, but for children, it's required. Next, we're going to be going over workers' compensation, what happens while you're injured at work. A workers' compensation insurance will cover you if you're injured at work. So it's not just health insurance, but it's crucial if you are hurt on the job. So this is a state-mandated insurance program. So a lot of employers are required to have workers' compensation insurance. This provides benefits to employees who experience job-related injuries or illnesses. This covers medical expenses, so all costs related to work injury or illness. Covers wage replacement, so partial wage replacement during recovery. Rehabilitation, so physical therapy and job retraining services. And death benefits for people if they die on the job. So this is going to cover medical expenses, type of almost like disability, right? So this is almost like a type of medical expense insurance combined with some sort of wage replacement and then some sort of almost long-term care or home health care treatment as well. And then some sort of life or accidental coverage. So it's like a lot in one package. So we're going to look at workers' comp versus health insurance. So who pays? So in workers' comp insurance, the employer is required by law to pay. In health insurance, the employer and or the employee pays. What's covered? Only work-related injuries or illnesses are covered under workers' comp, but in health insurance, all injuries and illnesses, whether they are on or off the job, are covered. There are no deductibles and no co-payments for workers' comp, whereas in health insurance, as we've been studying, there are deductibles and co-payments. And the employee gives up the right to sue the employer in most states if they accept workers' comp, whereas it's not applicable to health insurance. So employees are covered. Independent contractors are usually not covered unless it's specifically included in the employer's policy. Okay, so some important workers' compensation notices here. Workers' compensation laws and benefits, they vary by state. So requirements, coverage levels, and processes differ across different states. So just know that it can vary by state. Coverage only applies to injuries or illness that happen in the course of employment. So you have to be performing your job duties or on the work premises during work hours. And there's a trade-off. So employees receive guaranteed benefits without proving the employer was at fault, but the employees cannot typically sue their employer for work-related injuries unless it's gross negligence. So You say, okay, I'm going to be covered if something happens at work, but I can't sue the employer if something happens because I have workers' comp insurance. So next, we're going to be talking about the tax treatment of health insurance. So don't miss the next video. Okay, today we're talking about the tax treatment of health insurance. So what you pay, what you save, and what is tax-free. We're talking about here, first, the tax treatment of individual health plans. Individual disability income insurance is not tax deductible, meaning you have to pay with after-tax dollars. Meaning if you make $1,000 a week after taxes, say you get $700, you have to pay that premium with that $700 that you get after taxes. But the benefits when you get them are tax-free. Okay? So when you pay the premiums, the benefits tax-free. Individual medical expense insurance, the premiums may be tax deductible if medical costs exceed 10.5% of your AGI. Benefits, tax-free. So health insurance benefits are tax-free because they're restoring you to a position you were in before the loss. Now, group health plan premiums, the employer contributes. So they're tax deductible for the employer. So the company paying for your health insurance can deduct the premiums from their taxable income as a business expense. So it's not taxable income to the employee. So they don't consider that income for you. Employee contributions are generally not tax deductible. Okay, so employee contributions are generally not tax deductible. So if you contribute to your own plan, it's generally not tax deductible unless your medical expenses exceed 7.5%. It might be 10% of your AGI now. Premiums for group disability and group AD&D are not qualifying medical expenses. Okay, and why this matters. The government provides favorable tax treatment to encourage employers to offer health insurance benefits to employees. So they encourage employers to do it and saying, hey, we'll let you write some of this off on your taxes. So next, we're going to cover some more tax treatment of group health benefits, or of the group health benefits, not just the premiums. If you're serious about passing your insurance exam on the first try or the next try, if you've already failed, I've got you covered. Click the link in the description to check out our pre-license courses with a 93% pass rate. We hope over 30,000 people per month get licensed, so let's make you next. So medical expense benefits are not treated as taxable income because they are intended to cover losses you experience. So it's restoring you to your financial position. Okay. Disability income benefits are not taxable if you paid the premiums, but if your employer paid the premiums, then they are taxable as income. So if it's an individual plan, usually it's not taxable. If the employer paid the plan, usually the income is taxable. Okay, so hopefully this makes sense. Key rule: for disability income, whoever paid the premiums determines the tax treatment of the benefits. So if you pay the premiums, the benefits are tax-free. If your employer pays the premium, the benefits are taxable. Next, we're talking about death proceeds and non-discrimination rules. So death benefits paid to a named beneficiary under a health policy are not subject to federal tax income. So typically death benefits under a health or life policy are not taxable income, but they might be included in the insured's taxable estate and subject to estate taxes. But you got to have like millions and millions of dollars for that. Non-discrimination rules. These are designed to prevent favorable tax treatment for plans that don't offer equitable benefits to a range of employees. So plans must benefit a large cross-section of employees, and if they are designed only for the owners and officers of the company, they cannot be tax deductible. So in order for the plans to be tax deductible, they have to offer benefits to everybody, not just a specific group of people. And in video 18, we're going to be putting it all together. Then we have a few other videos that we're going to go through. Okay, well, we're going to skip video 18 because this is just, I have some other stuff to cover here first. And these videos do put it all together. So I don't know why I put that slide there, but I did. Next, we're going to cover claims, reserves, and subrogation. So this is how claims get paid. So this is understanding some basics of the claims process from filing the claim to that claim getting paid. So this is why health insurance claims are complex. With life insurance claims, it's very simple. The policy says exactly how much benefit there will be. The person dies and the benefit gets paid. Super easy. Say it's $100,000 if you die. No calculation needed. It's a quick process. Just prove that this person's dead and that they didn't, that they died under certain conditions, and then we're good. Health insurance claims are complex and variable because the amount is not predetermined. It's based on a specific loss incurred. It's not like a specific value all the time. It has to cover, you must verify covered expenses. So you need to make sure that the expenses are like actually covered, and you get reimbursed up to policy limits. So sometimes policy have limitations and each claim is different. Hey, Soki. Chill. Sorry, my dog's tweaking out. Hold on, let me get her to. Oh, this is real life. Okay. So we look at medical expense insurance. The key difference is medical expense insurance is a reimbursement. It's an indemnity contract. Pays for the loss. Life insurance, accidental death and dismemberment, and disability income is a valued contract because it pays a specific amount. Medical expenses, reimbursement, or indemnity, life, AD&D, and disability income are valued contracts because they say pay for specific fixed amounts. So we'll get into some differences between reimbursement and valued contracts here. We've already covered a good amount of this, but medical expense insurance is a reimbursement contract, and then the valued contracts, we just covered these. Payment basis reimbursement contracts pay the actual loss incurred. There's no predetermined amount unless there's like a maximum. A calculation is required to verify the expenses, right? Remember, like using UCR, usual, customary, and reasonable, or usual, reasonable, and customary. I don't know if it's URC or UCR, I forget. So, for instance, generally they're tax-free, and the hospital bill, $10,000, insurer reimburses covered portion. These are valued contracts. It's a fixed amount in the policy. The amount is predetermined. There's no calculation needed because the set amount was already figured out. Tax treatment depends on who paid premiums, really just for disability. Life insurance and accidental death and dismemberment policies, the death benefit is always taxable unless there's estate taxes. The death benefit is always tax-free unless there's estate taxes. Example, $100,000 life insurance policy or accidental death policy pays exactly $100,000. Disability income policy that says they're paying 60% of your income. That's a very basic calculation. I guess a calculation is involved, but you know exactly what it is before you even file the claim. We're going to cover insurance reserves. So there are two types of reserves. There's unpaid claims reserves, which is money set aside for future claims payments. So the insurance company needs these legally. They're needed for claims filed but not yet paid. They're needed for claims incurred and not yet reported. And they're needed to ensure that the company can pay all the claims. So they need to have reserves for unpaid claims. And they need unearned premium reserves. So this is a portion of the premium that's allocated to reserves. So this is needed for premiums paid in advance. This is for coverage periods that have not yet elapsed. So if the coverage period hasn't finished, and it must be available for future claims. So reserves are like a savings account. Insurance companies must maintain adequate reserves to ensure they can pay all their claims. It's a legal requirement to protect policyholders. Next, we'll go over subrogation, an assignment of benefits. So this is the insurer's legal right to seek reimbursement from a third party responsible for causing a loss. Example, you're injured in a car accident and it's the other driver's fault. Your health insurance pays your medical bills. Your insurer seeks reimbursement from the at-fault driver's insurance. So this is subrogation. It's when they seek reimbursement from a third party. Your insurance recovers costs paid on your behalf. Okay, so basically the insurance company goes after the other person's insurance because they were the ones at fault. When you assign benefits directly to healthcare providers, it makes the claims process more convenient. The provider gets paid directly instead of you paying first and getting reimbursed later. And a lot of people can't afford to pay first and then get reimbursed later. So say you get sick you get sick, you have to have surgery. A lot of times people can't cover that out of pocket, so the benefits are assigned directly to the insurance company. Okay, in the last video for this chapter, we're going to cover group funding arrangements. So these are alternative funding methods for health insurance. Rising healthcare costs mean that employers are creating new funding solutions because of how expensive it's getting. So the traditional model is fully insured, where the employer pays all the premiums, the insurance company pays all the claims and assumes all the risk. Very simple, but it's expensive. The alternative models are modified and self-funded. So the benefits are better cash flow management for the employer with some potential cost savings. They may have more control and flexibility, and there's a shared or transferred risk between the insurer and the employer. And the reason this change has happened is because healthcare costs have risen so much over the last 20 years. It's pretty crazy, which forces companies, especially big and medium and big ones, to look at alternative funding methods to control expenses because it gets pretty out of hand. So we're going to look first at modified fully insured plans. These are plans that modify the traditional fully insured structure while the insurer still pays all promised benefits. So if you look at here, we have fully insured, and then we're going to look at modified fully insured. So the key characteristic is that the insurance company remains responsible for paying all the benefits, but the employer gets more flexibility in managing costs and cash flow. This is typically only available for medium to large employees, because smaller companies, employers, because a lot of companies don't have these. Now, in a premium delay arrangement, you get a normal fully insured plan with a premium due within 30-day grace period. There's cash flow constraints for the employer. So the premium's due and you got to pay it. With a premium delay arrangement, which is a type of modified fully insured plan, this allows the employer to defer premium payments beyond the usual 30-day grace period. So you guys are learning about grace periods right now too, which is if your payment's due on the first of the month, you have a certain amount of time between when you need to pay and when the policy lapses. Now, the employer, you can extend it to 60 days or even up to 90 days. And this helps improve employer cash flow, and the insurer still pays claims immediately. So basically, maybe they pay all their premiums like quarterly, and then they have a grace period or something. So the employer can hold on to money longer before they have to pay. Okay, so this helps them make interest on some of that money too that they can use to offset. So reserve reduction and retrospective premiums. Okay, so in a reserve reduction, the employer keeps part of the annual premium. Okay, so the amount kept is the claim reserve amount. The claim reserve is funds set aside for expected claims. So the employer holds this money initially, and it's used to pay claims as they occur. So if there's some extra money, the employer might be able to hold it, and then they have to come out of pocket for it after. And then retrospective premium. So these are when premiums are adjusted at year end based on actual losses. So the provisional premium is collected at the start. So the employer has to pay a certain amount up front. And then at the end of the year, it's adjusted based on actual claims. So if the claims were very low, the employer gets a refund. If the claims were very high, the employer might have to pay a little bit more. Both arrangements share risk between the employer and the insurance company, rather than the insurance company bearing 100% of the risk and the employer having to pay so much money up front. So we're going to look at shared funding and minimum premiums as well. So shared funding, the employer pays smaller claims. See, shared funding, so the employer shares in it. They pay smaller claims. The insurance company pays larger ones. So the employer selects a deductible. The employer self-funds claims up to that limit. Once it's reached, the insurance company takes over. So example, say there's a $50,000 deductible. The insurance company pays the first $50K, with the insurance company paying anything above. So that might help them have lower premiums, right? Because if they're paying the deductible, they may have lower premiums. Minimum premium, the employer pays expected claims. The insurance company covers the excess. So the employer will insure routine and expected claims, so normal things, and they'll decide what is considered routine and expected. They pay out of pocket up to a set amount, and the insurance company covers the costs that exceed that threshold. So this protects from unusually high claims. So this is when the business assumes predictable costs and the insurance company takes on catastrophic risk. So if something crazy happens. There's also a 501c9 trust. So these are tax advantage funding vehicles. So a 501c9 trust is a special funding vehicle for employee benefits with tax advantages. So it must provide eligible benefits only. The only purpose is to offer benefits to members and beneficiaries. So it's controlled by a membership, an independent trustee like a bank, or another fiduciary, which is someone who has financial responsibility for members. Contributions are tax deductible, just like premiums paid to an insurer, and this can be used to pay for insurance claims and premiums and stuff. And then there's self-funding arrangements where the employer takes on all the risk. So in self-funding, the employer has the full risk. Large employers can take on complete responsibility for funding healthcare claims. This means they pay them all directly. The employer administers the plan, and they assume all the risk if actual claims exceed the expected claims. So typically, large companies with thousands of workers are most likely to self-fund. Small and medium companies can't afford it because of catastrophic risk. The more people you have working for you, usually the more profitable you are, and the more the law of large numbers kicks in. Okay? Because if you have thousands of employees, you can assume that only a certain amount will have catastrophes. If you have like 20 employees and one has something crazy happen, it can really, really mess up your profits and hurt the company, put it out of business potentially. And some smaller employers will self-fund basic medical expenses while purchasing insurance for major medical benefits. So maybe they'll cover some certain doctor visits, some lab tests, diagnostics, outpatient stuff like that. And then here we're going to talk about ASO contracts. These are administrative services only contracts. So an ASO contract is when the employer purchases administrative services from an insurer or third-party administrator without transferring claim risk. So basically, the employer has a self-funded plan. They hire the insurer or third-party administrator just for admin services. They provide services like claim stuff, COBRA, prescription card services, and employee communication. So basically, they help with filing claims. They help with keeping benefits when people leave. They help with prescription stuff, and they help get people signed up for the plan. But the insurer or third-party administrator does not pay the claim. So basically, the employer says, hey, we know that you guys have all these services for admin set up already, so we're going to hire you to do that, and then we're going to pay the claims. And then these are some common ASO services here. So claims processing, well, we just went over those. Cool. All right. I think this is the last video. Yep. We're going to talk about ASO versus traditional insurance. So who pays the claims? In a traditionally fully insured, the insurance company pays the claims. In self-funded, the employer does. So basically, who pays the claims and bears the risk? The insurance company here and the employer here. The insurance company handles the administration. In a fully insured plan and in an ASO contract, the insurance company handles the administration. The premium is a fixed premium to the insurer in a traditional plan. But in an ASO contract, the premium is just a fee for the admin services. So it's going to be very minimal. The costs for a fully insured are predictable. But in an ASO contract, self-funded, it could be variable. So because you pay the actual claim. So maybe 1 month, no one gets sick. The next month, a bunch of people get sick. This is best for small to medium employees. And this is best for large companies willing to take on risk. So who uses ASO? Self-funded plans often use ASO contracts to handle the administrative burden while keeping the employer responsible for actual claims costs. This gets expertise without giving up control or risk. So thank you so much for joining me in this chapter's videos. I hope I didn't bore you too much. It's not always the most exciting stuff, but you do need it to pass your exam. So great. We'll see you in the next chapter.